Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This is the usual monthly update of the global monetary scene. This time I will indeed be focusing on the global monetary picture, but also saying one or two things about bafflement, and indeed bafflement about bafflement. The bafflement is by Professor Robert Barro at Harvard University, one of America's leading macroeconomists, but let me come to that in a second. First of all, the global monetary scene. I'm going to start off with the United States. In this chart, you can see that in the last few months, the growth of money has accelerated a little bit in the United States. In fact, the 3-month annualized growth rate is up at about 7%. And so that's, let's get too worried about that. And then look at the Eurozone. Now here too we can see a recent acceleration in money growth. This has come as a surprise to me, and it needs to be set in context. The European banking system is indeed not growing its risk assets, its loans to the private sector, not growing very much, and the European Central Bank has stopped buying government securities. So what's called the growth of domestic credit is very weak. The reason that money growth has bounced up, this again 7% or so 3-month annualized figure, is that there have been currency inflows from the rest of the world, meaning that the external influences on Eurozone money growth have been very positive. It's rather technical, but anyway, 7% or so also in the Eurozone. Then we look at China. Chinese money growth is much lower than it was, say, 10, 20 years ago, but it's still pretty respectable, again up at 7, 8% or so annualized basis. Then the 3 smaller parts of the world, Japan. The problem with Japan is that money growth has been for 20 or 30 years now running at around about 2, 3%, 1, 2, 3%. There's a little tail away at the end there, but that's in the context of these very low money growth numbers. Japan is the last big developing country that really matters in this context. Then we come to India. India has had curiously stable money growth at a rather high rate for several years now. The chart is messed up by an attempted demonetization of some notes at November 2017. If you ignore that, this is very steady growth of around about 10, 11% in Indian money. That still carries on. And then there's the UK, last in the class, I'm afraid. And in fact, the money growth has been weakening recently, and that may be part of why the economy is rather weak, and that may be the explanation rather than Brexit. But anyway, let's then bring this together, and we can see you've got India 10%, you've got 3-month annualized, you've got 7% or so US, Eurozone, China. I think my view about what the message of all this is that the current growth slowdown in the world economy is temporary. And although we can't anticipate what's going to happen to the global banking system and also to money growth in these countries in, say, early 2020, the safest forecast to make about 2020 is another year of roughly trend growth of the world economy with very low inflation. So despite all of the ups and downs and worries and problems that people always refer to, we live still in a very stable situation. And as I've said, the European Central Bank, Federal Reserve, and indeed the People's Bank of China don't want a recession. Inflation's very low. There shouldn't be a recession next year or indeed in 2021. Now, bafflement. I'm going to talk now about, just very quickly, about background to the Institute's thinking on money trends. Then going to refer to a fascinating article by Professor Robert Barro of Harvard University, and then say why I am bewildered, baffled, puzzled by Barro's bafflement. What lies behind all of the remarks I make is the theory of determination of national income, known as the quantity theory of money, also known as monetarism in recent decades. in which the driving force behind the growth of nominal national income is the quantity of money. And roughly speaking, and again, one doesn't want to press this too far, a acceleration of the growth of money of around about 5% from one year to the next should in the end be associated with an acceleration in the growth of nominal GDP, also by about 5% one year to the next, in due course, with all sorts of caveats. There is quite a bit of inertia in the short run in inflation trends. So when you get an acceleration in nominal money growth, you also get an acceleration in the growth of real money, inflation-adjusted money balances, and that tends to be associated with two things, associated with buoyant asset prices and then also above-trend growth of demand. So conversely, of course, if there's a slowdown in money growth. So these ideas are relatively simple ideas, but they then motivate the macroeconomic commentary and forecasting that I've been making for many decades and that the Institute makes as well. The key thing here, of course, is Milton Friedman and his summary of all of this, that changes in the velocity of circulation of money do happen, but they're relatively small compared with these enormous movements we see over the long run in national income and the quantity of money. Okay, now, Professor Barro. The remarks I just making are pretty standard, pretty conventional, not very startling to anybody who's thought about these things, or so I would have thought. But Professor Barro has confessed in a recent blog in it's called the Project Syndicate website that he's very surprised about recent macroeconomic outcomes in the United States. He's surprised that they've been so good. Since the Great Recession, the United States has had low inflation and pretty steady economic growth. He says that the Fed has only got a few instruments available to achieve these excellent outcomes, and he talks about the short-term rate of interest set by the Federal Reserve Fed funds rate. He describes this instrument as rather weak, and surprising that the Fed has done such a good job with such a weak instrument. He says that there are these theories that, once inflation expectations are that inflation will stay down, then those expectations themselves will have the result of delivering low inflation. And I think if I can just now quote from what Professor Barro says, he actually says here that very impressive. Frankly, I'm unhappy with this explanation. It is like saying that inflation rate is subdued because it just is. And I agree with that view that trying to explain a macro variable by expectations about that variable isn't very convincing. And then let me just quote what Professor Barro says. It makes me wish I had a better understanding of monetary policy and inflation. It also makes me wish that the people responsible for monetary policy, the Federal Reserve, had a better understanding than I have. Many readers, no doubt, would say that my second wish had already been granted because there's been this decade of wonderful results. Well, let us hope they are right. Now, this is very surprising because Professor Barro is an extremely distinguished economist. It's surprising to me that he hasn't had a Nobel Prize already, but I'm sure he's going to get one. And I suppose he's expressing a fairly common view in American universities. Now, I did give a presentation last year recalling Milton Friedman's work and giving a very clear explanation of why America's had low inflation and good macroeconomic outcomes in the last 7 or 8 years. There's now, of course, been another year, so we're heading on towards a decade of these very good macroeconomic results. And I said the key to it was contained in this picture, which I'm going to show you now. You can see we've got these successive 7-year periods of the growth rate, the quantity of money. And you can see that in the 7 years to 2018, you've got not quite the lowest growth rate of broad money in that period, but not far off, and actually the most stable growth rate of money in any of those 7-year periods since, since 1969. It goes back, in fact, to 1962, when the 7-year period started. So what we've had in that 7-year period up to last year, hasn't changed much, by the way, since then, is this very low growth of the quantity of money and very stable growth of the quantity of money. Okay? And then, what's been the results of this? Well, you can see, let's take the standard deviation of the growth rate of normal GDP. That period of stable money growth has been associated with very stable growth of normal GDP, very steady growth also of real output, employment growth, and so on. And then there's also been associated with the lowest inflation of any of those 7-year periods going back to the early 1960s. Now, so then we have, using Milton Friedman's and indeed general quantity theory view of the world, Milton Friedman's ideas, quantity theory view, it works. Essentially, we've had slow growth of money, we've had stable growth of money in the last, I focus on 7 years in the exercise, really about a decade now, and it's delivered low inflation and stable growth. There's nothing baffling about what's happened to the American economy in this period at all, and there are no mysteries in monetary policy. I'm sorry, Professor Barro, there's no real mysteries here at all. What's happened is entirely predicting what you'd expect if you believed in the quantity theory of money. So why is there any problem? Well, I think I'd focus on two difficulties, and these are difficulties, I'm afraid, that Professor Barro is extremely distinguished and so on, but he suffers from these two difficulties in a rather serious form. The first is that there's a lot of debate about what is the best measure of money in macroeconomic analysis. Now, the school of economic thought to which Professor Barro belongs, the so-called New Classical School, tends to focus on narrow money, M1, sometimes even on the monetary base. And I don't. I always look at a measure of money that includes all possible money balances. It's itself quite a slippery, tricky idea, but I always look at broad money. What's amazing is the Federal Reserve stopped publishing figures for USM3 in 2006. We can, in fact, work out what USM3 is doing, and in fact, it's prepared every month by a small US consulting firm called Shadow Government Statistics. And they deserve the plug, by the way. But one of the problems that Barro has is he looks only at narrow money. It doesn't work in recent decades. Sorry, you must always look at broad money in the US context. The old M3 measure is the key one. It gives the answer, the explanation for the low US inflation, the stable growth, etc. The other problem that Professor Barro has is that he tends to think of monetary policy as consisting only of the rate of interest set by the Federal Reserve. This is just wrong. In the last few years, we've seen the Federal Reserve and other central banks conduct operations called quantitative easing, quantitative tightening at the moment, being called other things in the history of economic thought, that have a direct effect on the quantity of money. Now, I know that the Federal Reserve says they don't target money. Look, it is just simply true that when the central bank buys something from you or me, then our bank deposit goes up and the bank deposit is money. Simple as that. Similarly, if they sell us something, we must pay for it from our bank deposit, the bank deposit goes down. There is an effect from these operations, direct effect on the quantity of money. It's also true that when the banking regulators change banks' capital asset ratios, that affects the growth of banks' assets, that then affects the growth of liabilities that are deposits that are money. So again, it's another way, quite separate from the rate of interest, in which the monetary authorities, the regulators, can affect the quantity of money. It may be that the Federal Reserve didn't intend to deliver this brilliant performance of almost a decade of stable money growth. Nevertheless, that is what's happened. And as a result of the stable money growth and the low money growth, you've had stable macro outcomes with very low inflation. There is no puzzle here at all. It's all consistent with the standard theory, the quantity theory of money. This idea that the rate of interest is the kind of the dominant force in the economy is a very serious mistake. And I would suggest that Professor Barro just gets out some data and he regresses the change in real domestic demand on the growth of real broad money and any interest rate variable, and I know that he will always find real broad money is the most powerful and effective variable in explaining the change in real domestic demand. Let me conclude with just two points. The first is that there's no puzzle here. I'm baffled by Barro's bafflement. This is standard, simple, straightforward economics. The second point is that whatever the Federal Reserve thinks it's doing, if in practice there is low and stable growth of the quantity of money broadly defined in the coming years, there'll be low inflation in the United States and stable growth of demand and output with good employment. Thank you.